Hello and welcome. Today we are going to pull back the curtain on one of the most exciting and, let's be honest, sometimes confusing events in the business world, how a company actually goes public here in India.
You know how it goes. You see a company's name pop up in the news, you hear about its massive IPO, and then suddenly everyone's talking about its stock. But how does a private company make that huge leap to being traded on an exchange? Well, that's exactly what we're going to break down today.
All right, first things first, the basics. What does it really mean for a company to go public? It's that massive transformation, that moment a private business decides to open its doors and invite all of us to be part of its growth story.
At the very heart of this whole process is something called a public issue. And it's pretty much what it sounds like. The company is making an offer to the public, saying, hey, we're selling a piece of our ownership, and you, yes, you are invited to buy in. This is that key moment it goes from being a privately owned thing to being owned by a huge family of public shareholders.
Now, there are two main ways this can happen. The one you've definitely heard of is the IPO, the initial public offer. That's the company's big debut on the stock market. Its very first time selling shares to the public. Then there's the FPO, or further public offer. This is when a company that's already listed decides to offer more shares, usually to raise cash for new projects or expansion.
So a company can't just wake up one morning and decide to sell shares. Oh no, there is a mountain of official paperwork involved, and it all revolves around one single, incredibly important document. Let's trace its journey.
And here it is, the offer document, also known as the prospectus. You got to think of this as the company's complete autobiography, its business plan and its financial report card all rolled into one. For you, the investor, this document is your single best source of truth. It details everything, the company's strategy, the risks involved, and exactly how it plans to use the money it raises. This document goes through a few key stages. First, a draft version is filed with the regulator, SEBI, for them to review. After that, we get the red herring prospectus, or RHP. Now, this one has almost everything an investor needs to place a bid, except for one critical detail: the final price. Once all the bidding is done and the price is set, the final prospectus is issued, with every little detail locked in.
Ah, yes, the million-dollar question. Or in some cases, the billion-dollar question. How on earth do they decide what a single share is actually worth? This is where things get really interesting.
And right off the bat, let's bust a common myth. A lot of people assume that the regulator, SEBI, sets the IPO price to make sure it's fair, but that's not their job at all. The price is actually decided by the company itself, working closely with its merchant bankers. Those are the financial experts managing the whole process. And it's all based on market conditions and, crucially, investor demand. So there are two main ways to set that price. The first is a fixed price issue, which is super simple. The price is set in stone from day one, take it or leave it. But the one you'll see way more often these days is the book-built issue. Here, instead of one price, the company offers a price range, or a band, and then lets investor demand discover the final price. It's way more popular because it lowers the risk of getting the price wrong. You see, this whole book-building thing is basically a dynamic process to figure out what people are really willing to pay. Investors place bids for a certain number of shares at a price they're comfortable with, as long as it's inside that price band. This single price point where most of the demand is clustered, that becomes the final issue price for everybody. Now, if you're a small retail investor like most of us, all this talk of bidding might sound a bit complicated, but don't worry. The book-built process has a really neat feature built right in to make it much, much simpler for you. It's called the cutoff auction. If you're applying for shares worth up to 2 lakh rupees, you can just check this box. What you're doing is basically saying, look, I'm willing to buy the shares at whatever the final price ends up being. And this is so useful because it guarantees your bid won't get rejected just because you bid a little too low. It keeps you in the game. So we know how the shares are priced and offered, but who actually gets to buy them? Well, the whole pool of investors is sliced up into a few key categories, and each one gets its own piece of the pie. There are 3 main groups in the mix. First, you've got retail individual investors, or RIIs. That's most of us, applying for smaller amounts. Next up are the non-institutional investors, or NIIs. Think of these as high net worth individuals making much bigger bids. And finally, you have the giants, the qualified institutional buyers, or QIBs. These are the big players, mutual funds, banks, insurance companies that invest enormous sums of money. And believe me, the shares are not just handed out randomly. In a typical book-built IPO, the pie is sliced very specifically. a whopping 50% is reserved for those big institutional buyers. Then, 15% goes to the non-institutional investors, and a solid 35% is set aside specifically for retail investors like you and me.
Okay, we are in the home stretch now. The bids are in, the price has been discovered, and the shares are being allocated. Let's look at the final steps and, of course, the all-important referee who oversees the entire game. I mean, with so much money on the line and so many moving parts, who's the watchdog here? Who is making sure companies are following the rules and that investors are being protected? That would be SEBI, the Securities and Exchange Board of India. They are the market's primary regulator, and their role in all of this is absolutely critical.
But, and this is super important, you have to understand exactly what SEBI does and what it does not do. SEBI's job is to make sure the company discloses everything an investor needs to know. They vet that offer document to make sure it's compliant. What they do not do is approve an issue or recommend it as a good investment. They will never guarantee you'll make money. Their entire focus is on disclosure and transparency, not on financial results.
Once the bidding window closes, a clock starts ticking, and the final steps happen incredibly fast. From the day the issue closes to the day shares are allotted and finally listed on the stock exchange where you can trade them, that entire process has to be done within a maximum of just 12 days.
So if there's one thing you take away today, let it be this. SEBI ensures disclosure, not success. The regulator is there to make sure you have all the information, but it's totally up to you to use it. At the end of the day, your greatest asset as an investor is taking the time to read that offer document and making a truly informed decision for yourself. So we've just walked through the how of a company going public from start to finish. But of course, that just leads to the ultimate question for any investor. Now that you understand the mechanics of the process, how do you figure out what truly makes an IPO a good investment and what's just hype? That, my friends, is where your real work begins.